What's going on, everybody? Chris here from projectoption.com, and I'm back with a new video on calendar spreads. So in this video, we're going to talk about what a long calendar spread is and how it is constructed, and then we're going to break down a long calendar spread example using historical option data, and we're going to visualize the components, and basically we're going to teach you exactly how a long calendar spread works. So a long calendar spread is an option strategy that consists of buying and selling two options of the same type, strike price, but different expiration cycles. Now this is different from a vertical spread, which consists of buying and selling an option of the same type and expiration, but different strike prices. So vertical spreads are called vertical spreads because everything's the same except the strike prices, while calendar spreads are sometimes called horizontal spreads because the only thing that's different is the expiration cycle. Now more specifically, with long calendar spreads, traders are selling a near-term option and buying a longer-term option of the same type, call or put, and the same strike price. So calendar spreads are either constructed with all calls or all puts. It doesn't really matter which one you choose. By the way, if you're brand new to the channel, please go ahead and click the subscribe button and go ahead and click the bell so you get notifications every time we release a new options trading video. Really quickly before moving on, let's just visualize the difference between a vertical spread and a calendar spread. So with a vertical spread, you're going to be buying one option and selling another option, and both options are going to have the same type and they're going to be in the same expiration cycle, but will have different strike prices. So in this example, we're buying an option at a higher strike price and selling an option at a lower strike price in the same expiration cycle. Now with a calendar spread, you're going to be buying and selling two options of the same type and strike price, but in different expiration cycles. And more specifically, with a long calendar spread, you will be selling an option with the near-term expiration and buying another option of the same strike price and type in a longer dated expiration cycle. Now typically traders will use the standard monthly cycles, so for instance you could sell an option in the nearest standard monthly expiration cycle and then buy that same option type and strike price in the next month's expiration cycle. Alright, so with calendar spreads consisting of two of the same options across different expiration cycles, understanding how the strategy profits can be very confusing at first. Now after this video, you're going to understand exactly how long calendar spreads work by seeing the breakdown of a historical calendar spread's components relative to changes in the stock price. So let's go ahead and get started with that right now. So in this example, the stock price at entry is $171.98, and to complete our long calendar spread, we're going to go ahead and sell the 170 call with 39 days to expiration and then buy the 170 call with 74 days to expiration. So as you can see there, everything is the same except the expiration cycle of the two options. Now, the calendar spread entry price is going to be calculated as the price of the call we purchased minus the call that we sold. So we're going to sell the 39-day call for $5.50 and buy the 74-day call for $7.75, which brings our calendar spread entry price to $2.25. Now when you buy a calendar spread, you're anticipating that the stock price will remain somewhere near the strike price of the calendar spread as time passes. Now in this case, since we bought the 170 call calendar spread, the trader is anticipating that the stock price will remain somewhere close to $170 as time passes. So let's take a look at what happened with the stock price after the trade was put on and how the calendar spread's price changed with those stock price changes. Now on the top part of this graph, we're looking at the changes in the stock price relative to the calendar strike price of $170, and at the bottom part of the graph, we're looking at the price of that long 170 call calendar spread. Now as we can see in this example, the stock price did hover around that strike price of $170 as time passed, and as such, the calendar spread's price also increased from the entry price of $2.25 all the way up to a price of $3.24. So why did the calendar spread's price increase? Well, if we look at the calendar's price relative to the components, we can see that over time the calendar's price increased, and that's because the short call's price decreased at a faster rate than the long call's price. So in this example, the short 170 call that initially had 39 days to expiration lost $3.94 of value over the time period, while the long 170 call with 74 days to expiration at entry lost $2.95. So since that short option lost more value than the long option, the calendar spread's price increased. Now I know that might not make total sense just yet, so just to be sure, let's go ahead and look at the math behind the calendar spread's price. So as I said before, the price of a long calendar spread is calculated by subtracting the price of the short option from the price of the long option. Now at the time of entering the trade, the short call's price was $5.50 and the long call's price was $7.75. So $7.75 minus $5.50 gives us an entry calendar price of $2.25. Now at the time of the near-term call's expiration date, the short call's price was $1.56, which is $3.94 less than we sold it for, and the long call's price was $4.80, which is $2.95 less than we purchased that call for. Now if we take $4.80 and subtract $1.56, we get a calendar price of $3.24. Since near-term options decay at a faster rate than longer-term options, the long calendar spread increased from the entry price, generating profits for the trader who bought the calendar spread. So now let's go ahead and look at the P&L of all of the calendar spread components to truly understand what's going on behind the scenes when you buy a calendar spread and the stock price remains around that strike price as time passes. So on the top part of this graph, we're looking at the changes in the stock price relative to the calendar strike price of $170. And on the bottom part of this graph, we're looking at the P&L of the calendar spread as a whole, but also the P&L of each option component of that calendar spread. Now, since we sold the 170 call for $5.50 and it decreased by $3.94, our P&L on the short 170 call is $394. Now, we bought the 170 call in the longer term expiration cycle for $7.75, and that option lost $2.95 of value, which means we lost $295 on the long call portion of the calendar spread. Now, since we made $394 on the short 170 call and lost $295 on the long 170 call, our net P&L is $99, which is explained by the calendar spread's price increasing by 99 cents. So in short, the reason a long calendar spread will increase in price if the stock price remains around the strike price is that the short option will lose value at a faster rate than the long option, which means you'll have more profits on the short option than losses on the long option. So when a trader buys a calendar spread by selling a near-term option and buying a longer-term option of the same type, they are anticipating the stock price to trade near the strike price as time passes. Now, if the stock price hovers around the long calendar's strike price over time, the short option will decay faster than the long option, which will lead to an increase in the calendar's price. Now, since we purchased the calendar spread, an increase in the calendar's price will generate profits for the long calendar spread trader. So in other words, long calendar spreads are positive theta positions, which just means that all else being equal, calendar spreads that are purchased will generate profits over time because the decay of the short option will be more significant than the decay of the long option. Now please keep in mind that we're not assuming any changes in implied volatility in the different expiration cycles. We're merely talking about the stock price relative to the strike price over time. Now I just want to end by saying that long calendar spreads are often said to be long volatility trades because the vega of the long option is greater than the vega of the short option, which results in a positive vega position. Now a position with positive vega is expected to profit if implied volatility increases. Now, unfortunately, my opinion is that long calendar spreads are not long volatility trades, and I'm not going to go into it here because I did a full video explaining this concept, which I'll link in the description. So go ahead and check that out if you want to know why I think long calendar spreads are not long volatility trades. Well, that's going to be it for this video, everybody. I really hope you enjoyed it and learned something about long calendar spreads. If you did, be sure to subscribe to the YouTube channel so you can catch all of our future content, and be sure to check out some more of our videos right now. Once again, I'm Chris from projectoption.com, and thank you for watching.